let's be clear. If you're in your 20s and watching this video, I believe a stock market crash is a great opportunity to be able to build wealth. A lot of people fear it, but ultimately it's the time to be able to build assets. Generally, how the bulk of people work is they like to invest when things are at all-time highs, when they're overvalued, and then they don't invest when there's market corrections. And suddenly all these stocks are going at bargain prices. So in this video, I want to cover a few different things. Firstly, why I believe this is a absolute opportunity. Secondly, the history in terms of market crashes and how they generally work. Number three, the numbers that make me believe that we're not that far from a crash. And number four, what I'm doing to prepare. Now, firstly, before we go into this in any detail, I want to make clear that a blood on the street scenario where there's a complete market crash is great. It's great for young people like us, but a lot of people do get hurt from this. And as a cold-blooded investor who's just focusing on making money, it isn't great when we see people get hurt. And the people that I believe are going to get hurt the most are people like baby boomers and boomers. These are people in their 50s and 60s who are about to set up for retirement. They have their 401ks and superannuation stacked in stocks, in ETFs that could potentially get absolutely pummeled by a downturn. These are people that I genuinely feel bad for, that can lose their houses and lose all the money that they worked for in their life. So there is a part of me that doesn't want to go out here and say market crash is great for everybody, because it can be quite sad. But here's the reality with market crashes. We've seen about 8 market crashes in the past almost 100 years, a bit more than 100 years, that have been more than 30% dips. So I'm going to pull up the list now. And generally, these are anywhere between 30% up to 86%, which we saw during the Great Depression. And these numbers generally show that a lot can happen very quickly. And by not being in assets in these moments, it can hurt. It can hurt in a massive way, because the biggest takeaway is that assets are opportunities that you need to be in during these moments, because you're getting all these negative values. That decline is just a discount on assets, and that's the opportunity to be able to buy. And that's why I believe ultimately it's the great equalizer when we see any kind of market downturn, because it is years worth of investing, and people that have years of advantages over you, that have been investing for 4 to 5 years longer than you, suddenly when you have a downturn like that, you're back on level with people that have been investing for longer than you, and you're able to buy at those old prices. We know what top-end investors say, like Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. That's being able to sit in hard times like this. And cash, combined with courage in times of crisis, is priceless. If you have the resources available during these downturns, it's a great opportunity to be able to get assets at basically fire sale prices. The way I look at it is, it's imagine going to your favorite store, maybe like a shop which has clothes that you really like, and seeing everything 60% off. You would go bananas if you went in there and you saw all that. You'd be buying a new favorite shirt, your new pants, shoes, everything. That's the same with how it works in investing, and that's how it's going to work in this case. Now, the other thing I want to note is the market generally does rebound eventually. Even in a blood in the street scenario like in 1929 and 1932, where things were bad, it took a long time for things to get going again. We're talking 25 years. There were assets that were doing okay during that period of time, but generally the rebound time is between, you can get 3 years to 4 years where it rebounds back to its old position. So that window, there's your opportunity to be able to buy assets. And I want to mention this because there's so much commentary in the space with downturns. You see people saying in the comment section, as in some videos, on some comments on X, that's the end of capitalism. You'll see gets like this, and it's where basically people are saying, okay, it's the end of the world and capitalism is over. But if you can be cool-headed and calm during these times, it's a fantastic way to be able to make great money. The numbers are there, and they show that although in a downturn it's hard, it's a great way to be able to make money. And from personal experience, I've not experienced a downturn, but I've watched one. I watched a 2020 downturn where things went down by 30%. During that time, I thought, man, it's not something that I want to touch. I'm horrified by what's going on. I think that we're going to be seeing a complete downturn. During that time, we saw the tech market absolutely go bananas after that 2020 period, and a lot of really good returns happened there. I wished I got involved in that COVID pandemic period investing and being able to get into some stocks. And it's a lesson learned for me. Ultimately, in these periods where things go down, it's okay to be able to sit in at bad times and be able to understand what's happening in the long term and be able to buy these assets in the downturn. First critical number that always catches my attention is the price to earnings ratio of stocks or groups of stocks. In this case, we're talking about the S&P 500, which is S&P 500 is basically the 500 biggest stocks in the United States of America. And what it tells you is basically how overvalued or undervalued is the asset. It's a ratio of the price of the asset divided by how much earnings that the stock has, which basically tells you, okay, is this price justified based on the amount that they're earning? Now, generally, if we look at the numbers, currently we're at 31 price to earnings. The general average or median is around 15 to 16, with a minimum of about 5 down that Great Depression period. So I can tell you for free that currently stocks are overvalued. And if we look at it historically, you can see when the downturns happen, it's in a very much V-shaped thing where we see a peak and it overvalues and then it comes right back down. We saw what happened during the 08 period, and there's the dot-com bubble right there where things got pretty high. It almost went to 43 before it came right back down to 17. Right now, I believe this number's too high, and I believe we'll see it go up again, maybe as high as 35 before it comes right back down. This number I use to understand whether stocks are overvalued or undervalued. That's generally the reason why I'm not interested in stocks right now. The Nasdaq is another one I like to keep an eye on. Historically, the Nasdaq has had a record high of around 38. It's had a median of around 24, and it's gone as low as 12. Right now, we're at 34. So we're near those all-time high periods. And the reality is, let's get rid of that average. If we look at those recession periods, which is marked in gray, we can see how quickly that downturn can happen. And that's where the opportunities begin and where you can move into these assets. And it's just something I'm keeping an eye on. Right now, it's definitely a bit high for my liking. And the other thing which kind of caught my attention was definitely the Japanese government bonds. I mentioned this in my previous video, but I want to mention it again because I feel like it's an important thing to know. Now, to explain what's happening, the Japanese government bonds basically tell you how much it costs to borrow in a country. Now, for a long period of time, this was at zero. What this meant was that you could borrow money in Japan for nothing, and that's what US investors did. They borrowed for basically nothing. They converted their yen to US dollars and then went and bought stocks and other assets, and they were able to make huge amounts of money while borrowing for nothing. Issue is now, all this borrowing is now coming back at them because now suddenly their debt costs something. Now that's a worrying sign because if they've got a lot of debt, they're going to have to pay back. And in order to pay back, it's very likely they're going to have to sell their assets. Now, when they sell their assets and there's a lot of selling, that can cause a downturn in the stock market. So again, it's just something which I want to note and something I'm keeping an eye on. Now, what exactly am I doing about this? I'm just a 24-year-old guy from Melbourne, Australia. I'm not anyone special, but this is just my general thoughts and just something for you guys to think about. Now, firstly, what I'm doing is I'm building a cash pile, basically having some money behind me. Now, this money behind me does two things. Firstly, it gives me a buffer. It means in case of any emergency scenario, any kind of unemployment or situation where things get really bad, I've got some safety behind me and I can sit. Now, this money will be sitting outside the banking system in case of a really, really bad scenario where we see some kind of bank run, which happened in 2008 and caused the governments to back major banks. If that happens again, I don't want to be involved, and I want to keep my money outside the banking system. So for that reason, I keep it in cash form. The second thing it's for dry powder basically, and having resources available to be able to make aggressive moves. While there's blood on the streets and while stocks and all these assets are down at those low prices, I want to be able to move and have the capital available to make investment moves and make aggressive ones while everyone's running away. So by having some money available, I can decide on buying some new assets depending what deals I see. It could be in commodities like silver, or it could be stocks. We'll see when that time comes, but it's good to have some available. The second thing is building positions in commodities. Now, as we know, cash is something which can't be trusted because of how much is being printed. However, assets that generally do well during these down times is stuff like gold. Gold is considered a pretty flawless asset, and although it's picked on by some people like Warren Buffett because it has no actual value that's created, what it is it's true money. And it's a safe haven asset where what it means is no matter how much printing is done, no matter how much devaluation of the currency there is, gold holds its value and it counters inflation. When the economy is doing bad, gold generally does good, and when the economy is doing well, gold generally does bad. So it's something that needs to be noted when you're looking at this. So investing in assets like gold or safe haven assets is always a good move. And number three, I'm looking to decentralize my income. Now, the one thing I'm probably unhappy about right now is my main source of income comes from my 9 to 5. Which means I've got a single point of failure. If something was to go wrong on my 9 to 5, there goes my income. And it means I'd miss out during this market downturn. So I want to be able to have multiple sources of income. And I'm trying to build that through a few different ways. Firstly, I've got YouTube, which I'm trying to do right now. Now, this is something that's a bit more long term because for sure I love and I enjoy talking about money. And the income that I'll be getting from this right now is pretty minimal. And it's not something I'm focusing on in the near term. It's more of a long-term thing, which will be happening down the line. It's just something I enjoy, and for now, it's a hobby. But the second thing I want to be able to do is be able to get clients for myself in a freelance style business. So I'm a data analyst and Power BI developer, and I want to be able to bring my services to other clients through systems like Upwork and be able to have my own freelance business. So instead of having that single point of failure in who I work for, I'm able to have multiple sources by having clients who give me consistent forms of revenue. And it means that despite some things going wrong and losing a few clients, I'll still have some form of income coming through, and it can help me out a lot. So there's some things I'm thinking about and just giving you guys something to think about. Now, am I saying time the market to perfection and wait for the perfect moment for the dip to happen? No. Continue to invest, be able to get into assets. My personal opinion, commodities like silver, gold, and Bitcoin are always going to be fantastic in the lead up to this. Don't really sit in stocks. That's my personal opinion, but it's not financial advice. Do your own research. But just understand that the opportunity is there, and it's something you shouldn't be scared of, but you should be happy for. Hope you enjoyed this video. Hope you like what's going on in the space, the information I'm giving you. If you're someone in your 20s who's learning to invest and build their income, this is the channel for you, basically to learn what the best moves are going forward. Hope you enjoyed this video.